I wish a hassle-free purchase as much as anyone else. And if you're like me, you want one too. My name is Jean Crasta. I was a financial advisor for 13 plus years, helping clients with their investments and mortgages. I helped them move into their first home, helped them with the mortgage, but helped them with their refinance, helped them with purchase of their rental properties, even helped them with small business loans. As a prospective homeowner, though, it wasn't always like that. I remember sitting in on my first home buying incident. The guy, God bless his heart, who I still am in touch with, filled out the information, gave me the papers to sign, and we walked out. Now, luckily, I was a joint holder at that time, and I got away with not knowing much. If someone had asked me, what did you just do there? I wouldn't have been able to tell them anything. Things have changed since then. We've had land transfer tax, we've had amortization changes, so many things, and you need to be aware of to have a stress-free mortgage approval. This webinar is for you if you have questions about lawyer fees, land transfer tax, down payment, or even if you qualify for your dream home or not. Staying informed, knowing step by step what's happening to the biggest financial request of your life. You're knowledgeable about where you are, things are time bound, ready to move ahead with the plans. That's what you'll get when you work with me. By working with me, you get into your home, get your refinance done, that one easy payment, or even be a multiple property owner. Today, I will share with you what are the elements of your information that are important and relevant to your credit application. We're going to go over, we'll cover the 5 steps of credit, how important it is to a lender, and what exceptions sound like. And of course, I will go more into the down payment or land transfer tax. If you stay with me until the end of the call, I'll give you a quick tip on how to know how much you qualify for when you're a first-time home buyer. I will teach you as much as possible what I can in this limited time we are together, and then I promise you how to take things further. I ask to hold your questions until I'm finished, so I can get a roll and give you as much information as possible in a short time together. I will cover the 5 C's of credit. Your application is your story. Your application is your story when we send it to a lender. The lender doesn't know you, they haven't seen you before. We are the people who package a story and give it to a lender. So it's our job to get the right information and present you in the best possible light. But for us to know that, first and foremost, we always need transparency, because with transparency from your side, we are able to package your information in the best light possible and send it to a lender who best suits your needs, right? So for example, let's take a look at what the 5 C's are for any lender to approve an application. First is your credit. Your credit, of course, precedes you. Your credit goes ahead of you. Your credit tells your story before you even land into any financial institution, before you set foot into their online web portal or into their brick and mortar store. Your credit precedes you. Your credit tells a story of when it was a tough time in your life, when it was easy, when you got your first car, when you got your first house, when times were tough for you and you were slow in your payments, when you bounced back. Your credit tells all this story. And when creditors, prospective lenders look at your story, they're happy. They're happy to know that you're this kind of person. You paid in time. You probably made minimum payments for a while, but you never skipped a payment. Or you've always prepaid. You finished your loans in time. You were steady. You have multiple credit products, but you know how to manage them. That's the bottom line. You might have multiple credit products, but as long as you're on top of them, you're not taking from Peter to pay Paul. That means not taking from one credit card to pay another safely. Then they're happy. They're happy. If you're not doing these things, you're managing it from your own funds, you're on time, you're not letting anything bounce back, and you're paying off and closing in time. That's important. Paying off and closing in time. Nobody's interested in seeing debt that carries on years and years and years, right? You might pay off one debt, start another debt, that's fine, but nobody's interested in seeing balances that have been going on for months and years together. It just shows that you do not have the capacity to pay what you've taken, right? So these things tell a story, and that is your credit. Most important. The next part is your capacity to pay back any lending information or lending you've taken. The capacity could be what's your monthly payment like? What's your monthly salary like? What are the other expenses that you have that impact your capacity to pay back this loan? What is your capacity? And that's when, as we as mortgage brokers, we need your information like what's your pay stub? Where did you make extra money? How can we show that? How can we prove that, right? We can't verbally say, hey, you made cash income on the side. Well, I can't prove that for you, right? I can't prove that for you. I can't verbally ask them to state, take something that I do not have paperwork for. So whatever you can prove, when we probe for information, when we ask information, that's why we ask, so that we can present you in the best possible light. We can tell them, no, um, Amit Shah has this is second job. That's his T4. He makes money on the side, or he's just taken a second job. And look, these are his consistent pay stubs for the last few months. We want to show every possible way you can qualify for the loan that you're asking. So when we ask for information, that is to always put you in the best possible light. So that's your capacity to pay, what you're making on a monthly basis, and how you can afford this loan comfortably, right? Not as a tight squeeze, comfortably. So that's your capacity. Next is your collateral. Collateral, is typically if you are taking a loan in the black market, for example, the rates are sky high. If you're taking cash advance from your Visa, the rates are sky high. They're like 22%. Collateral is a security for loan that you're taking, and because of that security, the interest rate is low. Now, typically for home loans, of course, the home is a security. For car loans, car is a security, right? And they're typically lower. They're on the either side of 5. Plus, car loans are typically 5 and plus 5, and home loans are 5 and minus 5, right? Depending on which lender you're with. So your collateral defines what your rate of interest will be, right? What your range of interest will going to be, right? And that's why home ownership loans are so much more better in North America, because the rates are absolute rock bottom as far as home ownership is concerned. And you want to leverage that. You want to get into home ownership and move away from rental as soon as possible. Because my friend, you're building equity in the property, and we'll come to that. In the sessions down the line. But that is about collateral. The fourth is your capital. The capital is when lenders want to see that are you putting all your savings into the down payment of this house? Do you have any backup cash? Some savings, some TFSA, some RSP, everything that you've not put down into the house. What if you are not able to go back to work for 3 months? What if you're on short-term disability? How are you going to make that payment? They want to see your capital, some sort of savings, some sort of backup savings. Most lenders like to see at least 3 months of expenses as some backup savings, right? That tells them that you're not running paycheck to paycheck, and that you have some access to additional cash flow in the event there is some sort of unforeseen circumstance, like if you suddenly have to repair the roof, or the furnace breaks down, or your washing machine goes for a toss and you need to invest in a new washer dryer. Then they want to see that you have some backup cash to tide you over these circumstances. Now, fortunately, these things don't come every day. So they might come once, one might come now, one might come later. Sometimes things come back to back, but most of the times these things are spread out. So while they loosely say about 3 to 6 months, they're not hard and fast, but definitely it makes them comfortable when they know that you've planned your expenses well, and that you have a bit of savings stuck aside that is away from your day-to-day paycheck, and away from the big asset that you've bought. That is your capital. And last, my friends, is the conditions. They want to know if you picked up a house and it has been, like if you overbid on it so much, and they want to know what were the conditions that caused that, right? Was it worth it? Did you just get into the fray? Was it worth it? And it helps to know that when you say, that, hey, everything about the house is new. You did the new flooring, new roof, new furnace, uh, new windows, everything that helps to add to the value of the house, and that could easily have added to a few thousands of dollars in expenses. It helps to let them know that you have considered all this when you were making your bid for the house, and that's why it's a little higher. Conditions could be also additional, that while you've qualified for the mortgage, you do have additional members staying with you that are earning, that can help with the mortgage expenses. Now, conditions often add to an application. They are not the reason an application is approved or not. And if your application is borderline, conditions might tip it over a bit to say, yes, you know what, let's give them an approval. Overall, the facts seem to be good. Conditions add to a mortgage. They don't make or break a mortgage, but they do add to a mortgage to shore up a mortgage, to strengthen a mortgage, to strengthen a deal. And we want to put in information about those conditions wherever we can to show the overall character, strength, and capacity of the person who's buying the property. So that, my friends, in short, was the 5 C's of credit. Now, in the recent past, when I was talking to a few of my first-time home buyers, they had questions about down payment, right? So they had down payment, of course. If you're doing 5% down, it has to come from your own savings. Almost 90% of the lenders will ask for that. They want to see 3 months of history according to anti-money laundering rules, AML rules. They want to see that the money has been in your account for 3 months and it's not some fly-by-night operator or not some illegal source of funds. That's why the 3 months of a statement, right, to show it's been with you. If you are doing more than 5% down, upwards of 20-25%, then the remaining could be source of gifted funds, depending on the lender. It could be gifted funds. Gifted funds normally has to come from blood relative, like your parents, siblings. That's it. One source of down payment that's not often spoken about, but can be an easy way of leveraging savings for you, is actually to put your down payment, if you're a first-time home buyer, into RRSPs. You do get to take out all your RSPs as the down payment, so you're not losing anything. But because you put into RSPs, you also get tax credit back. So that's additional savings that you did not have and did not count on, right? So that's leveraging that same money to actually get 3 benefits. One is you increase your RSP savings. Second is you get a tax credit that you didn't count on. So that's additional jingle in your pocket. And the third is, of course, it still counts towards your down payment. Now, the RSP, of course, if you do take it out, you do know that you have to put it back over a period of 15 years, and it works out to very reasonable, right? So if you reach out to me, I'll break out the calculations for you and show you how that's done. So that, my friends, is how you count in your down payment. Now, if you are having your parents, siblings send you money from overseas, you have to show paper trail for that money to show that it was in your account overseas and it's come here. So you need to show the Y payment details and your bank account details there for 3 months and here. Like I said, you need to show paper trail of gifted source of funds. If you have questions about gifted source of funds, reach out to me once again, and I will clarify that for you when I'm doing the application for you. Last but not the least is land transfer tax. Now, a lot of my clients, and some of them have been second and third property owners, they still don't figure out the land transfer tax cost. And broadly, I'll tell you, land transfer tax, if you're in Toronto, is about 1% of your purchase price, around that side. And if you're in Toronto, you have 2 taxes, the municipal and the provincial, to deal with. So land transfer tax works to a little more than 2% of your purchase price, right? Now, first-time home buyers, very good news for you that you get a portion of your land transfer tax back. And so for you, it works up to a little less than 1% when you're first-time home buyer. So some advantages there when you are a first-time home buyer. but this is additional that you need to count for down payment. If you're doing, say, for example, a 5% down payment, 5% is your down payment, you need to count additional 1 to 2% depending on where you're buying your property as land transfer tax. And you also need to count about, say, $2,000, give or take a few hundred for your lawyer's fees. So that's the amount of down payment you need to show to your bankers and to your lenders to say that, yes, not only do you have the down payment, but last minute you're not going to renege from the deal if you do not have land transfer tax, the government's land transfer tax and the lawyer's fees. So you want to show that you have all that there to close the deal. And the last but not the least, as we are nearing this, you wanted to know, I promised I'd share a tip with you about how you will know what is the number. What's the number to know that you are going to get qualified for your home purchase, right? So typically the rules in Canada are, right now the rules in Canada with the benchmark testing, with the stress test, benchmark stress test rate, is that typically whatever's your income, you would qualify for about 4 times your annual income as the property you're purchasing, right? 4 times your income is what you can safely count as loan for your mortgage. Each situation is different. It could be lesser if you have a lot of debt that we have to account for, that you have to make payments on a monthly basis that you're still responsible for. It could be a little more than 4% if you're doing 20% or more down, and we have the potential to increase your amortization and sort of, flatten your payments a bit. So there is a bit of wiggle room there, but a good rule of thumb is about 4 times your income is what you would get qualified for your first home purchase. If you have any questions, reach out to me. When you work with me, you know that you will get a stage-wise approval. We're clear with the documents we need up front, so there are no surprises to the lender after or once your application is in process. We're not going back and forth with, hey, can I have this? Hey, can I have that? No, that's stress. That's stress. So we want to make your first home journey or your repurchase journey as stress-free as possible. So we ask for transparency, we ask for your documents up front so we can package your story to the best lender possible and get you a very good approval, right? And you sail into your first home ownership or even your repeat ownership. My name is Jean, and I'm so glad you joined me today. I look forward to hearing from you and helping you on your dream towards your home ownership or multiple ownership. Have a good day. Bye for now.